Gold has been used as currency for thousands of years. On this video, we will take a look at how the use of gold has changed and the dynamic changes that occurred over the last 100 years as the United States and other countries globally went off of the gold standard. Because of gold's intrinsic value as an asset, it has been used as currency as far back as over 5,000 years ago when the Egyptians first started minting gold coins. It has been recognized as an exchange standard for international trade as the people of ancient Egypt leveraged the Nubian gold to build wealth for their empire. However, that was the beginning, and that trend lasted for thousands of years as multiple groups began using gold as money in the centuries that followed. And when the colonizers began voyaging to the Americas in the 15th century, the search for the metal became a European obsession. The Americans were home to rich gold deposits, and countries like Spain, England, and Portugal sent explorers to bring it back to Europe, where it would become the basis of their economies. In fact, by the 17th century, England started setting up goldsmith bankers where people would store their gold. And these bankers would give people running cash notes as a type of receipts when they deposited their gold. The note essentially was a promise to pay the depositor their gold on demand and was an indication of the eventual move towards paper money in Europe. In fact, the use of gold as money created what we now call the gold standard, and that arose from the widespread acceptance of gold as currency, which began thousands of years ago. The gold standard, simply put, is a monetary system in which the standard economic unit of accounting is based on a fixed quantity of gold. As the United States was formed, they initially used currencies of other nations, such as Spanish and English coins. However, they made the decision around 1792 to begin to mint their own gold coins as well as gold certificates in terms of currency. And that was called the Mint and Coinage Act of 1792. This act passed in Congress authorized the federal government to use the Bank of the United States to hold its reserves, as well as establish a fixed ratio of gold to the U.S. dollar. Gold and silver were used as legal tender. From 1792 up until 1933, the United States was truly on the gold standard. A $20 gold bill, as well as a $20 gold coin, were interchangeable because the U.S. dollars were backed by the gold reserves of the United States. As you can see from the currency on the right-hand side, it was affixed with a gold certificate note, meaning at any moment you could take that to any bank and receive a $20 gold piece in its place. But that all changed in the 1930s. The first move taking us off of the gold standard was the Great Depression that occurred in the 1920s and 30s. It caused then President Roosevelt to enact some extreme measures to rebuild the economy. In 1933, President Roosevelt enacted a major executive order, and Congress then passed the Gold Reserve Act in January of 1934. This nationalized all gold by ordering the Federal Reserve banks to turn over their supply of gold to the U.S. Treasury. It also asked citizens to turn all of their gold into the U.S. Treasury.
The origin of America's gold reserves dates back to 1933, when President Franklin Delano Roosevelt outlawed the private ownership of gold by U.S. citizens in an effort to jumpstart the economy during the Great Depression.
Roosevelt realized that the only way in order to bring the country out of that depression was for the federal government to control the money.
Under the watchful eye of federal marshals, citizens were required to turn in their gold coins, bullion, and even gold paper certificates at the then current exchange rate of $20.67 per troy ounce. Failure to comply was punishable by heavy fines and up to 10 years in prison. Almost overnight, U.S. gold reserves swelled to 5,000 tons, melted into 368,000 uniform bars, each weighing 27.5 pounds. 1 year later, Roosevelt raised the new fixed price for U.S. gold to $35 an ounce.
The difference is the government had the profit, not the individual people.
This dramatically changed how the United States moved from the gold standard to a modified version of it. For private citizens of the U.S., our currency was now fiat in that it was no longer backed or redeemable for gold. However, it was still backed by gold for transactions involving country to country. The U.S. Central Bank and the Federal Reserve had doubled the budget to rebuild and stimulate the economy following the Great Depression of the 1930s. It stayed like that until the end of World War II. The destruction of so many countries and the cost to rebuild was so massive that sticking to a gold standard was not possible if the world was able to fund the reconstruction of many of the countries destroyed. The gold standard would not be able to stay in place and rebuild many cities destroyed during the war. Collectively, the world's government needed more money than there was available to accomplish this massive endeavor. The solution was to modify the gold standard as it was in 1944.
After World War II, it was clear the world needed a new financial system. The gold standard was considered too rigid, but at the same time, economists were worried that countries would devalue their currency to boost exports. For this reason, 44 countries sent delegates to a conference held in Bretton Woods, New Hampshire, as of the 1st of July, 1944. The U.S., which held 2/3 of the world's gold reserves after the war, was obviously the most influential player, and ultimately, all currencies ended up linked to the dollar, and the dollar was linked to gold. One important concern arose, though. If a country goes through an economic crisis, how can it get out of it without devaluing its currency? To address this issue, two institutions were created. One, the International Monetary Fund, which was supposed to lend money to countries that are in trouble and cannot attract financing from other sources. Two, the International Bank for Reconstruction and Development, which is now called the World Bank and was supposed to help less developed countries grow. Unfortunately, as good as it may have sounded on paper, the Bretton Woods system didn't survive because the United States kept running deficits to fund various projects, and therefore, the amount of dollars in existence kept increasing while the gold reserves of the U.S. kept shrinking, as more countries demanded gold in exchange for their dollars. As such, on the 15th of August 1971, Nixon officially announced that dollars would no longer be convertible to gold, thereby putting the final nail in the coffin of the Bretton Woods system.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what does this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar.
This act by Richard Nixon did in fact end any sort of gold standard whatsoever, And for the first time, we truly had not only fiat currency for U.S. citizens, but between governments. They were no longer to redeem their U.S. dollars into gold unless the U.S. government approved that. This was the final straw that broke the camel's back in terms of the gold standard in the United States. To put this all into perspective, before 1933, a $20 gold coin and a $20 bill were equal in buying power. In fact, you could use either one of them to buy a hotel room at the plaza, which costs $8 per night, and to buy a steak dinner, which at that time cost approximately $2. Additionally, with that $20 gold coin or bill, you could buy a nice suit and a hat for the cost of about $10. However, to give you an idea of how much the dollar has lost its value, if you take a $20 bill today, it's worth about $20. It would not buy any of the items we mentioned, because if you add the suit at $750, a hotel room at the plaza, and dinner even at $100, the total of that is about $1,550. At the current value of gold, just under $1,800, that gold coin still had the same buying power as it had in the 18 and 1900s. This clearly illustrates how much the dollar has fallen as America watched a 20-fold rise in the average cost of goods, an average of 3% a year. While you could buy all of this for a $20 gold piece, that $20 bill would buy a couple of cups of coffee. Certainly, the dollar had lost almost all of its value when compared to 1933.